financing your next billion gain insights into successful engagements with venture capitalists and investors. Get ahead of industry trends, hear from industry leaders, influencers, founders, policymakers, and governments. Stay in the know on how to finance your next billion.
And thank you so much for joining us on FYNB. I'm your co-host, Siobhan Gamble, and I'm here with my co-host and cohort, Jerome Curry. Jerome, how was the day yesterday for you?
Let's see. So the day yesterday for me was actually pretty good. I had some a few snacks going on, kind of set the atmosphere a little bit. So made some great nacho dip. So it worked out pretty good. And so my wife liked it. So anytime my wife likes my food, that's that's always a good thing. I try to do my best in the kitchen, and so it worked out pretty good.
Okay, well that's good. That's good. I actually made some chocolate chip homemade cookies yesterday, and they're all gone, so they must be pretty good. So yes, it's been a while. Since I made some homemade chocolate chip cookies, but I just had a inkling and I did it. So yeah, it turned out really nice. Well, today
Awesome.
on the show, we're going to be talking about how can you guard against the misuse of a bank guarantee or standby letter of credit. With anything in the financial world, we always have to, there's always going to be a contingency plan in, because anything, that can get entered into, there can be breach of contracts, there can be, where, something is not adhered to, there can be different things that can happen. So there always has to be a plan in action, in motion that says, what are the remedies for these different things, that might happen. So we're going to start off here. I'm going to start us off talking directly about, what assurances do we have, once it's sent, that it won't be misused, cashed, or called in. And one thing that you do have to know with the bank guarantees, standby letter of credit, these are transferable instruments. If they were not transferable instruments, there would be no way to transfer it to a bank or to an insurance company or a financial institution. They would not be able to transfer that to the SPV, the special purpose vehicle that we actually talked about in episode number 3 when we talked about that. You would not be able to transfer it to that type of instrument. So what then would constitute that it would not be called in or cashed in? But there's going to be several mechanisms, they're going to be set in place, and it would have to be some type of a breach of contract. So the terms and conditions by which the bank guarantee or the standby letter of credit are set in motion, those are going to be agreed upon before it actually, gets sent. In other words, both sides are going to have to agree in whole, not simply in part, but in absolute whole. Everybody's got to be in absolute agreement exactly what's going to happen and agree to all the terms and conditions that are there. Because once the standby letter of credit is actually set in, if there's something that happens and there is disagreement and you want to call that or you want to cash that out, that's going to basically bode very unfavorably for either side that does attempt to try to do that. So what you want to make certain is that you take your time going over those terms and conditions and make sure that's something that you can adhere to through the inception, through the completion of that entire project. Jerome, can you give us some, any words on this as far as calling that in? What happens is, if that just has to get called in, then what?
Yvonne, I want to say this. I'll start it off by saying this. When things go wrong, don't go with them. And here's what I mean by that. Uh, there are going to be things that aren't going to go exactly according to plan. That's why you spent the time in developing the contingencies. That's why you spent the time in developing workable solutions. In the last resort, in the absolute last resort, we were reserved where there is no solution. And usually when there's no solution, I'm going to guarantee that there's been a track record of very little communication. And when there's no solution, and there's been a significant breach or non-compliance with the terms and conditions, the capital guarantee can be called back as a last resort. Let me tell you, this is an absolute last resort because, again, banks are in the business to lend money, and institutional investors are in the business to make money and via the return on investment. So they're not in it that after they spent a significant amount of time and capital in underwriting your project and looking at it to make sure that it would work, they're not in it to basically pull back the project. What they want is going to be something that I'm going to kind of go over. They want clear communication. Things going wrong happens. I mean, it happens. But one of the things that happens for companies and construction professionals is that when things go wrong, they have this tendency to get ghost. And they get Casper. I mean, you can't find them. You can't get anybody on the phone. And what's happening is that, that startup company or that construction company or that project, they're fretting. They're afraid. They don't know what to do because things have gone wrong. It didn't go according to what we thought was going to happen. And so what happens is that there's no workable solution when that happens. They start to think, I don't know what we're going to do. I don't know how it's going to work. And they don't see the benefit in mentorship. They don't see the benefit in communicating, and they don't see and they can't come up with a workable solution. It's one thing that when the bank comes to you and they ask you what happened to your Casper the Friendly Ghost and they can't find you, versus someone that says, you know what, listen, we're going to be proactive. We want to go ahead and contact you in advance and listen, this is what happened this quarter. This is what happened this month with our project. This is where we are. And we are this way because of what happened in the economy, what happened with with the lockdown, what happened with resources. This is where we are right now. However, here is our plan moving forward. That sounds so much better as opposed to crickets. And Yvonne and I can tell you, when it comes to providing information, people tend to get ghosts at times, and those are the wrong times to get ghosts because, again, that absolutely kills the relationship. Having a simple plan of communicating what's going on with your project. What are how are the milestones coming along? All of these things strengthen the of not going against or not having your capital guarantee called back. Here's the thing: take action, be proactive, come with solutions, and then have a strong financial controller that can help you steer the ship away from potential icebergs. Don't be the Titanic heading for the iceberg and not have someone that can help you steer the ship in the wrong direction. If you see the iceberg coming, start letting people know, hey, there's an iceberg. There's a problem coming up. We had a delay in supply. We had a delay in getting material. This causes some mishaps to our timeline. But guess what? We're still going to be on schedule because this is our contingency. That simple communication can help save your capital guarantee. Yvonne, what did you think on that?
I'm in total agreement. And one of the things that you might want to look at, and one of the things that Sam Pete offers, and that is when we actually are closing our capital investments with our clients, and that is to have someone that helps to mitigate the risk of the investor as well, and that is have someone who can actually be on board there. They don't have to stay there forever, but they are there with you through this process so that you kind of have that, we act as a third party. We'll put someone in as a third party to work at your company, to look at those milestones as you approach them, to look at those benchmarks as you are approaching them, not after the fact. And the reason why we like to look at them as you are approaching them, so that if anything can be that needs to be changed, we can get ahead of the curve, as opposed to after it's done, and then we're trying to catch back up and go forward at the same time. We can kind of avoid and avert some different things. So we usually put in people who are experts in your industry, in that field, and can help you, so that you can you can steer that ship clear of that iceberg, so to speak. So what we want to do now is we're going to take a short 60-second break. We're getting the flashes here from our sponsors. We're going to hear a word from our sponsor, and we want you to come back after the 60-second break, and then we're going to be talking about what constitutes an incurable breach and what is a draw period. So we were going to be talking about those two areas when we come back after the break. So please return and stay with us here on FYNB Talks.
Where do you want your product shipped today? Make Mobamed your PPE inventory warehouse.
Okay, and thank you for coming back after the break. If you're just now joining FYNB Talks, I'm Yvonne Gamble, and my co-host here is Jerome Curry, and we're coming back and we're discussing what types of ways that you can guard against the bank guarantee or the misuse of the standby letter of credit. Now, as promised, the first thing we want to just jump right in and talk about those incurable breaches that may happen. Now, let me just kind of give you, obviously, one would be a misappropriation of funds. One would be that the company, as Jerome talked about before we went to the break, they ghost and they just left. They closed up, they left town, didn't have a forwarding address, no way to reach them. Or, most certainly there was misrepresentation, or just gross negligence and fraud that they had committed about what they could do or what they would do or what they had in place. And there was not enough due diligence on the part of the investor to actually to check those different types of things. And sometimes this does happen with bank guarantees, with standby letters of credit. They know the people, they've been out there, they've done business with them for a while, but they'll get into a situation and they'll misrepresent what they can do in this new setup that they have. And then there's one that actually can be pretty well cured. And that's, again, what Jerome had talked about, that communication. And that's if the draw period expires. If the draw period expires, you simply, with something like that, before the project is actually completed, we can simply extend that because, you always will have those types of things where you run out of money or you run out of time, what have you, and the project is not completed. So that can always do a project extension. And if you are doing, what we had talked about earlier before we went to the break, and that was if you're having to bring in, our people, to bring in people who actually help you through the process and who are there to kind of, not to get into your process, not to rewrite your, your product or your software, hardware, what have you, but to kind of be there to help you move along that curve to assure that those benchmarks and milestones are actually being met. And what we're going to kind of go over next is we're going to talk a little bit more in depth about the draw period and what that actually, would entail for you, and what you can do during that time, because that draw period, Jerome is going to go over with you just how critically important that is to a project.
Yvonne, it's very critical because the draw project helps you to forecast when you're going to need the money that you're going to need. So basically, the draw period is a span of time of which the funds are going to be deposited to the SPV or to the account. And this is typically pre-approved. So this is something that you've already have taken a look at and said, you know what, this is an adequate draw period that I think would work very well for us, for our company. And I think that this is something that would work out really well. Now, here's the important part of it. When we talked earlier about the total project cost, did you really sit down and estimate out how much you're going to need for each drawdown period? Did you have, conservative estimates and then have a little bit over more? How did you do your draw period? Because that's going to be very important. And the reason why that's going to be important is because this has to be submitted pre-funding. This is a part of your package going to the actual investor. So what that means is that you have to forecast and look at your project and say, wow, you know what, this is how much we're going to need for each period. And we've added in a little bit more just to be on the safe side. So this is how much we're going to need. Now, what typically happens and what happens with a lot of companies is that they say, well, you know what, we only need this amount. And then you have to go back and have a conversation, a very tough conversation with the investors. Say, listen, we need to adjust our draw schedule because this happened. Now, I'm not saying that that's wrong to do. However, with some excellent planning, you can forego that uncomfortable conversation. If you knew how much, if you knew how much, let's say if you get paid every, if you could choose how often you get paid, they say, listen, we're either going to pay you, you can choose how often you want to get paid. Do you want to get paid every week? If you want to get paid every week, how much do you need every week? And you say, well, you know what? I only need such and such and such for every week. Well, it becomes a very uncomfortable conversation to go back and say, well, you know what? I got to change this. And then you get to another draw period. And it's like, well, I need to change this again. And then the investor starts to ask, well, how many times are you going to change this? And did you really spend enough time estimating out your costs so it doesn't build that confidence, that confidence and that relationship? Because every time you have to go back and have those conversations again, it just looks like, well, you know what, you didn't do a lot of planning in the beginning. So really, you don't want to have those uncomfortable conversations. And really, what happens is that this usually corresponds where you're only paying interest on those funds. So again, it's so important to make sure you're estimating your projects the right way. Yvonne, what are your thoughts on that?
As you were talking, I couldn't help but think about burn rate. And we don't really, that's something that you really, we have tended to, when you look at the financial projections or what have you, that's something that we tended to have gotten away from that conversation. And that's a conversation that needs to be had with your financial team. And that is, what is our burn rate? That should probably be something that you should be thinking about, as you are developing your, your financials and your projections. Your burn rate is, how much money am I going to burn through in a month? How much does it cost me? How much is it going to cost me to bring on new employees, to do new advertising, to take on new manufacturing plants, new vendor, new software, new hardware, new fleets of trucks, or whatever it is that you have, new materials, all those different types of things, and how much am I going to use? Many times when we're doing estimating and cost estimating, we want to estimate, we try to be conservative. There's conservative, throw that word completely out. You can't be conservative until you're making your own money. When you're making your own money and you're spending your own money, then you can be conservative. But when you're having to go out to the marketplace and to get money and to assure, like Jerome says, you're not going back and going through that draw period and asking for more money, more money, more money, and you're running literally yourself completely out of money, you need to overestimate. I would rather, instead of say plus or minus 4 or 5%, I'd rather overestimate my product by about 30%. And you may think, well, who's going to give that to you? Have an explanation for that. The reason I'm going to, that I'm estimating 30% over is because costs. Once I get into and I start servicing the clients, it's one thing to get new clients. You know, it's kind of like the .coms did. They got all those new clients, but they had no capacity. That's what turned them, you know, belly up, was because they had all these clients were coming in, they had all this traffic coming in, and then they didn't have the back end part built. So now they had to then scramble, and they spent most of their monies that they had gotten initially on salaries, on infrastructure, facilities, giving these nice, big, huge stock option plans to everyone. And so they had very little money to actually run the operation. And then as they began to take on more customers, people wanted what they were offering. They couldn't offer it because they didn't have it, and they had spent the money. So if that's what your plan is and that's how you're operating, you'll be the same way they are. They're gone. Wow. And so therefore, you know, you've got to say to yourself, you know, I'd rather operate and anticipate that, yes, I'm going to get new customers in. And when those new clients come in, they're going to have new things that they want to have done. I'm going to have to expand my operation as I'm growing. I'm going to have to grow as I'm expanding. Both of those things are always going on simultaneously, you know, as your business is going through its day-to-day operations. So that's what I would say, that really to go through an effective draw period, you're going to want to know what is your burn rate before you go into, so that you can effectively, you know, manage just how much you need to actually be taken, you know, as a draw, and what's going to really make sense.
Absolutely. Perfect. Okay. That is excellent. That is excellent information. And this really prepares you. This really starts to prepare you for your project. It really helps you to estimate your project. It really helps you to be successful. And then it helps you to be able to have that foresight. There's nothing like being able to see over something. Someone said to me that eagles, they see they fly through the storm, and they can see it, and they can see beyond that storm. And so you want to be that eagle. You don't want to be that pigeon that's down there getting that's flailing everywhere. You want to be the eagle soaring above. And so
there you go.
That's all that I have, Yvonne.
Okay, well, that's pretty good. Well, again, we want to you're here with Jerome and with Yvonne on FYNB Talks. And if we're talking about, if you see the two of us together, we're talking about financing your next billion and how you can do it. So we'd love to have you join us as a guest on the show, and you can reach us on LinkedIn, or you can reach us at either of the websites at Sanpete Financial Group or Platform Capital, platformcp.com. And we'd love to have you as a guest on the show. Just come on over, talk about, you know, how you're handling your financing, what you're doing, successes, failures, transparencies, you name it. We want to hear from everyone. And as always, if it's financial talking, it's FYNB. We'll see you on our next show. Thank you.
Financing your next $1 billion? Contact us to be a guest. Join us for the next show.